Okay, if everyone's ready, we'll call this meeting to order. Okay. And we do have a quorum. And Madam Clerk, would you please call the roll?
Senator McDaniel. Senator Mills. Senator Neal. Senator Nemus.
Present.
Senator Parrott. Senator Thayer. Senator Wilson. Representative Duplessis.
Here.
Representative Fleming. Representative Graham. Representative Petrie. Representative Pratt. Representative Weber. Representative Wheatley.
Here.
Mike Harmon. John Hicks. Victor Maddox. Sharon Mattingly. Representative Miller.
Here.
Senator Higdon.
Here.
Representative Tipton.
Present.
We do have a quorum, and so we will proceed and entertain a motion for approval of the minutes from our last meeting. We have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed? The ayes have it. Thank you very much. Our first presenter today is Bo Craycraft, Executive Director, Judicial Forum Retirement System. Bo, the floor is yours. Identify yourself for the record. Please proceed.
Good afternoon. My name is Bo Craycraft, and I'm the Executive Director of Judicial Forum Retirement System, and it's an honor to be here today. I appreciate your all's time. I'm here, was asked just to provide a quick investment update as of the first quarter of the recently started fiscal year 2023, so just 3 months in. And so with that, I'll get started with my first slide is just a review of performance. And in short, what we saw in the first quarter was a bit of a continuation of what we had experienced in the final quarter of the prior fiscal year. Not quite as significant. In the second quarter of 2022, we saw assets decline pretty sharply. S&P 500 was down a little over 15% just in that 3-month period ending June 30. For the start of the fiscal year, July, we saw a bit of a little bright spot. Markets bounced back in July, but in August and September, we saw that exuberance turn pretty quickly. And so for the quarter, you can see that our assets were down 3.3%. That slightly exceeded the benchmark return of 4.2. Looking at the 1 year, you can see that 13.3 to 13.7, depending on the tier of assets, and pretty much in line with the benchmark. Not surprisingly, just as a reminder, we're 70% equity, 30% short-term, mostly high-end corporate fixed income. And so, we expect some volatility. Looking longer term, you can see we believe over a market cycle of 10 to 20 years, holding a portfolio of large, strong companies with strong leadership will provide excess returns. So when you look at a 5 or a 10 or a 20-year trailing period, those returns have exceeded the stated benchmark return, which is a mix of that 70% S&P 500 and 30% fixed income. We just had our board meeting last Friday. Heard from Baird Trust Company, who is our sole source investment manager. They do expect volatility to continue, especially in the equity markets. And they do believe that as we continue to deal with the inflationary pressure that the Fed's trying to react to, we're seeing some changes in sentiment, especially within consumer spending. And we're seeing some of these asset valuations, especially in kind of the real estate markets, come back to a new normal, or the old new normal, as some folks are saying. So we're expecting to see some volatility in return, especially on the equity side. The nice feature of it is we're starting to see, with the rising rates, fixed income is actually providing some level of return. the most recently fiscal year, we saw some really strong negative returns as the bond market was reacting to those rate hikes. But if you guys, if you think about it, for the last decade, really fixed income really hasn't provided any diversifying. We were in such a low interest rate environment that there really was nowhere to go. So we are seeing, especially in the first 3 months here, we saw that the fixed income markets actually provide some slight returns. So I think you'll continue to see that now that the yields are moving upward. Next is just a quick glance at asset allocation. For the first time really since I've been at JFRS, I've been here almost 2 years, we're really close to target. Over the past couple of years, we've tended to be slightly overweight equity, somewhat due to just the growth that's been experienced in that asset class, but again, also due to the fact that fixed income wasn't real attractive. Here more recently, we've done 3 rebalances in the last 15 months, and in all 3 of those, we've reduced our equity exposure back down to target, and they've been allocating those assets into fixed income. Last quarter, I made mention that our cash balance were at highs historically, and that was because we were having a harder time, finding some places to put that money, especially on the fixed income side. And that's still the case a little bit. Usually you'll see us closer to, a very marginal amount of cash. And the bond market is still reacting. And so, you're trying to find, better yields.
Bo, if you're in a place there take a question, Representative Miller has a question for you.
Well, Bo, welcome. Thanks for the information. So is Baird shortening your maturities on your bond side? What do you sense they're doing? And you got a little bit underweight now on.
We've always been within 1 year of the index. The index has a shorter duration, nothing really beyond 10 years. Mm-hmm. And it's been even tighter more recently because your yields have been, fairly low. The other thing you've really dealt with more recently is, a lot of things have been getting called early, or, they've been reissuing debt, at a slightly higher or a slightly lower yield to pay off existing debt. But when you look at our duration, we're usually about a year less than the index and nothing beyond a 10-year maturity.
Okay. And is there any particular reason why legislative has 3.4% in cash and judicial only has 1.4%?
It's really more of a timing issue, and generally speaking, the legislature, it just has a little less assets. The contributions that we're receiving and the benefit and the expenses are a little bit less, and so we try to raise money kind of in coordination. We usually when we raise money for benefits, the legislature, in order to take a sizable amount, for cash flow purposes, it usually lasts us 3 or 4 months, whereas judicial we're doing more like every other month.
Okay, thank you.
I don't really have any other prepared comments other than to say that for this quarter, I also included in the back of your packets, I don't plan to speak to it, but just some recent market commentary that was shared with our board at our meeting last week. It's a quarterly commentary that Baird provides, and it's always available if you want to look at our board materials. It's always included. The long story for them is, they Andy Means is the lead portfolio manager, and I liked what he said on Friday. He said he quoted a guy named investor by the name of Howard Marks, and he said, in a business world, and a lot of you all have run businesses or have been in leadership of businesses. He said, perception goes from it's not very good to pretty good, right? Things are not going so great, or they could be better. But he said in the stock market, perception goes from flawless to hopeless, and so he said, they were talking about how what you see in the market isn't really an accurate picture of what the underlying businesses that they hold have. And, a CEO is never going to tell you that things are flawless with his business, right? He's going to say they're pretty good, but or he or she's going to know that there's things that could be improved. Whereas in the stock market, you see a lot of reactionary. It's either based out of fear or it's based out of greed. And so you lead to these big swings. And so they have not made a single change to the portfolio. There's been no buys or sells since the end of March when we did a rebalance. And so, they feel this is a spot where there's no need to react. They plan to maybe add to some existing positions, but there's nothing in the portfolio that they think is broke when you look at the underlying companies.
Both seeing no questions, if that concludes your presentation, thank you for being here.
Thank you.
Our next presenter, Bo Barnes. While Bo's coming forward, want to welcome Michael Clancy. He's new staffer to the PPOB. Michael, where are you? All right, let's make Michael welcome, if you will. Welcome. There's never a dull moment here, Michael. So, and I want to remind everybody, if you say again. Okay, I stand corrected. There are some dull moments. Just want to remind everyone that if you have a proposal for next session for a retirement proposal, or a bill that you're going to want to hear in the next session, we'll hear those proposals. We'll hear them in November, December, and our January meeting. If you want to get on the agenda, please contact staff, and we'll make sure we get you on the agenda. But look forward to hearing those proposals. Bo's always good to see you. If you're ready, identify yourself for the record.
Thank you, Mr. Chair.
And please proceed. Your report's a little thin, but
Yes. Thank you, Mr. Chair. Bo Barnes, Deputy Executive Secretary and General Counsel for Teachers Retirement System, or TRS. I was asked today to provide investment returns for various periods of time for the quarter ending September 30th of this year. And with that, we'll go to the first slide. As a reminder, TRS is a long-term investor. We don't worry too much about quarters, years, even brief years. We're a long-term investor. We invest for the long term. We adhere to a certain discipline over the long term. And if we adhere to that discipline, which we do, then that will pay off for the retirement system's investments over the long term. Looking at the most recent quarter and these year-end returns, the pressures on the market that existed when we reported on the last quarter in a previous meeting still exist today, as Bo Craycraft noted, and we're still dealing with those same pressures. And I think Bo discussed what those are that we're dealing with. But you'll go to the bottom left-hand box on the bottom line of this slide, and you'll see the net quarter return was negative 4.13%. For the 1 year period, negative 14.31%. For the 3 year period, a positive 5.08%, 5 year 5.47%, 10 year 7.6%, 20 year 7.09%, and then at the bottom you have the compounded gross return over the 30-year period of 7.47%. Again, just noting that we are a long-term investor. We adhere to a certain discipline in the investment process. Now that we are getting full funding in the budget, and the budget for the current biennium we're in provides full or very, very, very near full funding for TRS for 8 straight years. And I've discussed before what a change that's made in the investment process at TRS. So we have that. We had the additional $479 million that came in the current budget, coming in at a very good time. So with that, when the market was up, when the stock market was up, we were able to sell off about $2.5 billion in stocks. We are, now that the market is down, we are in a very disciplined and prudent manner, investing back, not just in stocks, but some of these other assets classes with that additional money that we had. So again, there are advantages even in down markets to be taken, that you can take advantage of. And certainly we're doing that now. Let's see, and that was for the retirement annuity trust. I apologize, I should have noted that. Now we have the health insurance trust, same format. And again, these are preliminary returns, but they're not going to change. The final returns will not change much. Lower bottom, left-hand, on the left-hand side of the box there, for the quarter, negative 2.98%. the 1 year negative 12.9%, 3 year a positive 5.29%, 5 year positive 5.43%, and 10 year 6.47%. And that's the return information as of the quarter, updated for the most recent quarter. With that, be happy to take any questions that this body might have.
Thank you, Bo. Chairman McDaniel has a question.
Thank you, Mr. Chairman. Bo, good to see you again.
Thank you.
You guys are on a 5-year smoothing as well, right?
That's correct. Yes, sir.
Okay, so knowing that although under statute you're not governed under ARC necessarily the same, we ultimately end up paying you or paying into the system as if you're on an ARC. I would like you to go through an exercise, not right now, but
Yes, sir.
just between here and the middle of November, get us something back. If you took what you're currently showing is your 3-year return, so at 5.62, and assuming that that's your smoothed average, I'd like you to take a look at fiscal year 24, 25, 26. Give me a 5-year, in essence, forecast of how much additional cash TRS is going to need to survive. I mean, the beauty of this committee, Mr. Chairman, and a lot of people have done work, we said is this stuff is coming to light now, right? That we simply just didn't, the General Assembly as a body didn't pay as much attention to previously. And we ought to take a hard look now because we know it's coming. I mean, let's not fool ourselves. There's going to be a spike in contributions to these systems. So, Bo, if you could kind of just start to give us an idea now, and I know it's super hypothetical, right? But let's use your 3-year, your 5.62. If that's your smoothed average that we're looking at in the next 5 fiscal years, how much additional cash are you going to need in order for us to keep meeting the ARC or the ADEC?
Yes, sir.
All right, mid-November?
Yes, sir.
All right, cool. Thanks. Thank you, Mr. Chairman.
Thank you. Chairman Tipton has a question.
Thank you, Mr. Chairman. Bo, appreciate you being here. I do have a couple of questions. How many basis points are you all at now as far as admin costs and cost of investing?
Cost of investments is just over 30 basis points, 30 hundredths of 1 percentage point. Admin, it's much lower, obviously, and I don't have that number is
Okay.
escaping me right now, but
That's
I'd
all
be
right.
glad to get that. We
But
do
the
maintain
investment cost is 30 points.
just over 30, yes, sir.
Okay, yeah, get that. If you could get that number to us broken down in the total, and what are your asset values at the end of fiscal year 22 compared to the end of fiscal year 21 with the negative returns?
Slight decline, from the end of the fiscal year, June 30th, to the last quarter, September 30th. We were at $22.9 billion June 30th for the pension fund, retirement annuity trust. We were at $21.3 billion September 30th for the retirement annuity trust. On the health insurance trust, we were at $2.26 billion June 30th, and as of September 30th, down to $2 billion.
And
So modest decreases with the continuation
but
of those
I think
market
that
pressures.
question goes in line with Chairman McDaniel's question about you doing the 5-year smoothing. How's all this going to play out? I think, and I appreciate him asking that question. It's one I had on my radar as well. So, in all likelihood, based on what we're looking at now, I think it's a definite possibility when we come back to 24 budget session, you're going to be asking for additional dollars. Does that sound like a reasonable expectation?
I think it's reasonable. It's not necessarily certain, but it's certainly reasonable and likely, I would say. No crystal ball for what the market does
Yeah.
the year after this one or the year after that
Yeah.
one, but
Now, in fiscal year 21, if I'm correct, your returns were in the 29% range. Is that
that's correct.
range? And with the losses that we're having now in forecasting, how much of that gain is gone, or do we still have a gain from that, or is it averaged out since then?
Well,
we're getting close to averaging out.
That was a big gain that we went up from that base, and now we've had a reduction from that higher base. We're at, I think, $26 billion retirement annuity trust, a little over $2 billion, in health insurance. Not a big change there, but 2 point something, north of 2 point for the health insurance trust. So there is obviously some erosion with that. We had an exceptional year in 2021, and we all knew it was an exceptional year, not to be repeated. And this is an off year too. It's had its own difficulties, but we still have some gain from 2021. I couldn't quantify that, though.
Have you changed your investment strategy in the last year? How have you changed that in relation to where the market is today?
Well, what we do is, because we're a long-term investor, we adhere to this long-term approach. And it's very simply, we have a process in place where when the markets are up, we sell. You know, we reap harvest off of when their markets are running hot, and then when they're low, when they're down, that's when we buy. And it's just that old adage, buy low, sell high. And you have to have the discipline to continually do that and follow that discipline. And over the long term, that's shown to serve us well.
So is it safe to say you all have been buying in the last 12 months?
Yes, sir. It's we did take off $2.5 billion when the market was up. So we're putting that to work now that the market is down.
Okay, thank you.
Thank you. And Chairman McDaniel has a question.
One more quick follow-up, Bo. Just remind me of the mechanics of the timing. So when you closed out 22, that will not impact your valuation until fiscal year 24. Is that correct, or am I off by a year there?
There's a lag between the valuation that's done every year and then the impact. So that's, for our budget request. So that will actually be the year after.
So your results from fiscal 22 will impact the second year of the next biennial budget, or the first year of the next biennial budget?
First year.
First year. Okay. Very good. Thanks.
Representative Miller.
Thank you, Mr. Chairman. You made a comment that you haven't really changed your investment strategy, but you did lower your outlook. I mean, the return expected from 7.5 to 7.1, I think.
That's correct.
Okay. Which normally you would think you would gear back and be less aggressive. But they didn't make any change to their investment plans?
No.
When
we
lowered your expectation?
We lowered the assumed rate of return to 7.1%, but we're not investing to 7.1%. We're still investing the same way, and we hope to achieve better than 7.1% over the long term. But to answer your question, no, we did not change.
Okay. Because to address Chairman Tipton's comment, the ups and downs we've seen of COVID and inflation and Ukraine war and all the rest of this over 3 and 5 years, it's still about 5.3 to 5.8 range. And you all are still projecting 7.1. I know 10-year and 20-year are a lot more than that, but I think next year, when you all are obligated to relook your investment returns and under what was that, House Bill 76, unless your crystal ball is clearer than anybody else's, I think you're going to have to lower that even further, from 7.1. So, just an observation. I won't be here to comment on it, but I'm guessing. So
we'll see what the actuaries come back with when they finish the experience study on those, as you noted, those economic factors
yeah,
like
because
the
as
assuming
you
return.
lower that, you're going to have to. That raises the amount of money the state has to provide. So there we go. Thank you.
Yes, sir.
Representative Duplessis.
Thank you, Mr. Chairman. Thank you, Bo. I'm over here
Okay.
to your left.
Oh, I'm
There-
sorry.
There we go. There we go.
I thought you were behind the pole over here, maybe.
No, that's okay. We've seen the markets fall a bunch in about 3 months, and which is about the same time that I handed over the House reins to Representative Tipton. I just wondered if you could explain if that's why the markets have fallen. If he is to blame for the negative numbers we're seeing here. No, I do have a serious question. And I do know you're investing on the long haul, and I'm quite aware of that. I think we all are, and we appreciate that fact. If you're chasing things, you'll end up getting caught. I understand that. But what we saw in KERS and to some degree, and maybe TRS in the 08, 09 declines, where the systems were spending principal in order to pay for benefits, and it was a significant amount of principal, especially in KERS. So in this downturn that we've seen, is the system paying down, having to use principal to pay off benefits at this point?
Well, there's always going to be some principle. Some of the assets of the system are always going to be applied to pay benefits.
Okay,
Those
let
in
me
income.
rephrase my question. Are you having to spend more money on principal money than you expected to have to pay for that? And what is the long-term effects if that's the case? When it does rebound, it rebounds small, it doesn't come back to where it was. So can you explain if that's a bigger spend than you expected, and if so, what's the impact?
It's when the market is down, if you're, it's a there's probably a more complex answer than I can give today. As you heard Bo Craycraft talk about, we've seen some increases in interest rates. So that helps. That's on the positive. Cash flow, having that income generated, and we again took $2.5 billion off the stock market when it was hot, so we had some validity there. Plus, we had the additional $479 million, in the budget. So that was some just additional cash or additional, ability that we had to not only, just to actually keep on investing back in the market, buying stocks, buying real estate, buying timberland. So I think we were poised pretty well. I don't think that the more recent downturn in the market has had a serious impact on the amount of assets that we're having to sell right now. But it may be a more complex answer to that, and I'd certainly be glad to look into that and get back with you.
I would have kindly asked for a more detailed response maybe next month.
Yes, sir.
And I'm not trying to be a pain, but this is big stuff. And we saw, especially in KERS in 08, 09, a major impact that when we had to spend so much principal, that when the markets did come back, and they will rebound, we all realize this is the long haul. But when they do come back, they came back much smaller because they had to spend principal. And I did want to make sure that TRS is not in that situation. And if you are, we'd like to know how much so.
Yes, sir.
Thank you.
Thank you all. One final question, Bo. I don't see any other questions, but ballpark figure, what are our funding levels now on the two funds?
Well, I can give you what it was as of June 30th, 2021. It would really be just a guess for me to do it as of June 30th, 2022, because there's so many things that go into that, not just the returns, but, there's a lot of other factors, actuarial, factors that go into that. How many people retired, payroll, all those things go in. But as of last year, the pension, June 30th of last year, the pension was 57.2%, and health insurance was 61.7%. I'm sorry. Yeah, it was 60%, June 30th of 2021. So 57.6 for the pension, 60 for health insurance. And of course, the actuaries will be working on the valuation for fiscal year 2022. We report that by November 15th of each year. So we'll have a very good idea here very shortly.
Okay. Well, seeing no further questions, that concludes our, your presentation. And unless you have any final parting words for us.
Again, we appreciate the funding we're getting. Again, 8 straight years, that's wonderful. It's really turned things around for the retirement system and the way we're able to invest. So we're all very appreciative of that. Thank you.
Do you have any idea what the balance or the funded ratio is now compared to when it was back in 16 when we started putting in the additional money?
I don't have that off the top of my head. I do not. But I'm glad to get that. We've a lot of things have happened over that period of time, aside from just the funding. The change in assumptions. Certainly changed. The measurement of liabilities. So a lot of things happened over that period of time. But the additional funding is making a huge huge difference. And it may be more incremental in the beginning, but it'll be gaining speed, and and again, we would be, without that additional funding, we wouldn't be 57.6% funded as of June 30th. We would be something far, far, far south of that, and we would be in real trouble. So again, it's game changer.
Would it be too much trouble to ask on the next one when you give the 1 year, 3 year, 5 year, 10 year, 20 year, I guess the funding level at those points, dollar amount? It'd be interesting to see where we were and where we're at now. Percentages are good, but those dollar signs, they're easy to read too. Thank you, Bo.
Thank you.
Next up by Zoom, we have David Eager. And I understand David's under the weather, and he has some staff here that have come to the table. And
Yes. I'm David Eager. I'm the Executive Director of the Kentucky Public Pensions Authority, and I have with me Steve Willer.
Good afternoon. I'm Steve Willer, CIO for KPPA.
Yeah.
Excuse me, I'm a little under the weather as well. I apologize.
So I was diagnosed with influenza yesterday. Steve was diagnosed with COVID a couple of days ago. So we decided it would better we stay home and not come into the office. But I always start off by saying I'm thankful for the PPOB, and I don't know if it was Senator McDaniel that said it, but if there had been a PPOB many years ago, I don't think it would be where we are, and I think it's very beneficial. I'm also thankful that we got some additional appropriations, $215 million in the state police in this past June, which took the funding level from 31% to 50%, because it's a small plan that had a dramatic impact. It brought the contribution rate down from 147% down to 99%. We've also gotten 470 more million over the next 2 fiscal years. The impact is smaller in percentage terms, but it helps push us more toward full funding. So we're very appreciative of that. We're going to focus on the 930 quarter. In your packet is information that'll go out for 30 years. We thought we'd focus on the 930 quarter because I know Brad has got an awful lot of longer term information. We're just kind of tagging on this last quarter. We don't have a cash flow exhibit. I know we've talked about cash flow here. Almost all the plans are positive cash flow. Almost all of them have improved, even to the point where the C non-hazardous, which was a significant negative cash flow over the years, is down. I think in this last quarter was a -$8 million. That's before investment income and if there were any gains. But that's the net contributions minus benefit payments and expenses. So we're in very good shape, and Brad's information will substantiate that. I'm going to give you a few highlights. I'm going to ask Steve to go into a little more detail. To the question that was asked earlier, if it's still on your minds, I looked at and this has to do with the kind of the amortization of the 5-year returns, but I looked as of June 30th of 2021, our market value was about $2 billion more than the actuarial value. So that's a cushion that we're going to continue to amortize in. We're going to lose something in this current fiscal year with the returns of -5% to -6%, but we had a nice cushion built up between market and actuarial value. But if you go to slide 2, please. So we've had challenging markets. Everybody's talked about that. Steve's going to show a little bit of market environment background. Brad Gross is going to add a lot to it. We're fortunate we've exceeded our benchmarks substantially. I wouldn't consider that we can do that over any longer period of time. And if you look over longer periods of time, we've beaten our benchmarks by 10 to 20 basis points. But 10 basis points is worth $22 million to us. So if we can beat by 20 basis points, that's $44 million over the benchmark. And the benchmark is taking our targeted asset allocation and investing in indexes. So we're either making adjustments above or below the targets, and we're either picking better or not better in terms of who's running the money. But on balance, we've been adding value over all periods of time. We pretty good take pride in our risk-adjusted returns when we look at Wilshire information, and we think that's going to continue in the first quarter of fiscal 2023, and that is on a risk-adjusted basis, we're in the top decile, and a return basis lately we've been in the top quartile. Partly attributable to conservative position, partly not skill but luck, or not luck but skill, however I want to say it. We are designed to be a conservative, lower risk in all the funds we invest in. So when we're in troubled markets, we will look good. Next, please. So if you look at the last quarter, the 1 year, the 3 year, the 5 year, the 10, 20, and 30-year periods, in the pension plans, we've beaten the benchmark in 94% of those quarters. Now, that doesn't mean that if you took each and every quarter for 30 years, we've beaten it 94% of the time. It says that in the most recent period, ended September 30th, if you look at 5 different plans in 6 different time periods, or 7 different time periods, there's 35 measures. And we've outperformed in 33 of those 35 measures at those periods. In the insurance, we've done it 69% of the time. So it's a real consistent outperformance. Again, not 94% of every quarter, but in those time periods, 94% of the time. And we're continuing to look for opportunities to invest. Steve can address that more, but you were talking earlier in some of the discussions, but we have been over allocated in cash for a variety of reasons, not the least of which is the appropriations they've gotten. The termination of a manager who had about $900 million, the cessation of an employer, all of those brought a lot of cash into the system, and we've been deploying it over a period of time. We currently, in a more recent period, we've either deployed or committed about $2 billion in assets across all plans. So, Steve, I'll turn it over to you.
All right, thank you. Good afternoon. Again, this is Steve Willer, CIO for KPPA. I'll just quickly flip to page 4. And really, this is showing, as has been well covered already, the first quarter of fiscal 23 was a continuation of the theme we saw at the end of fiscal 22. There were very few safe harbors for investors to hide in the first quarter, with negative performance across almost all asset classes, and with quite a bit of variance. And we see in the fixed income markets, negative returns again, which is unusual. I think as was mentioned before, fixed income has typically been a ballast for the riskier parts of the market, being the private and the equity side, and has not served this purpose, at least recently. But with the rise in yields, the expectation is that it will become more of a ballast once the Fed and global central banks, once they get inflation under control and the quantitative tightening it has peaked. So we anticipate that in the coming quarters. I don't think we're there yet. So we continue to expect volatility across all markets, day to day, week to week, and month to month. So I think we're being cautious, as Dave mentioned, in deploying capital in our allocations where we see opportunities. Our sizing of our allocations, we're reallocating at least on a monthly basis. They've been in smaller bite sizes than what we would typically use, and that really has to do with the level of volatility that we see in the markets. Jumping to page 7, page 7 and 8 are preliminary, and I would caution they are preliminary. I don't expect them to change much in the coming days, but we should see final performance soon. These are estimates of performance net of fees for the pension and insurance plans. And as Dave highlighted, performance across plans held up relatively well in the first quarter, given that level of market volatility. For the 5 pension plans, performance ranged from minus 2.1% to minus 3.0%, and performance in the insurance plans ranged from minus 2.3% to minus 3.0% as well. And more importantly, I think outperformance, as Dave highlighted, against the benchmark specific for each plan ranged from 120 to 170 basis points for the quarter on a net basis in the pension plans, and range from 160 to 190 basis points for the insurance plans on a net basis for the first quarter. So We held up relatively well. That has a lot to do with both our allocation, which is a primary driver, as well as our positioning within our allocations, both on a manager level basis, as well as decisions that staff is making as to where we're allocating capital. Very quickly on page 9 and 10, those are updated allocations as of 9/30. And I would note that the allocations for plans that are outside of the current IPS allocation ranges are highlighted in red. The majority of these are in private asset classes where it can take longer to deploy capital. We're actively deploying capital and, excuse me, we're continuing to manage the funds towards the revised IPS allocation targets, investing those funds Dave mentioned from appropriations, cessations, and mandate terminations. We're also working with each plan's respective investment committee on potentially updating asset allocation targets and ranges given change in markets, as well as what the capital market assumptions are. There's both the rise in yields as well as the pullback in equities has caused capital market assumptions to change pretty radically over the course of this year. And so our expectations for where we might achieve return going forward has changed, and that may dictate that we change what our allocation targets are and what our ranges might be. Between capital that we have already committed, new mandates, and internally managed programs, we anticipate to have all plans within their allocation ranges by early next year. That's the goal we have for our strategic plan, and we anticipate achieving that. It is a little dependent on some of that committed capital being called by managers, and that will be driven by market conditions. We appreciate the prudence of our managers in not rushing to deploy capital and looking for the best opportunity. And I think that's been borne out in the returns of those individual managers. So we fully support that and anticipate, market conditions will dictate how quickly they can deploy capital. I know that was brief, but if there are any questions, happy to answer those at this time.
Thank you. We do have a few.
Sure.
Senator McDaniel.
Thanks, guys, again for your presentation there. Kind of same question that I posed to TRS. If you took a look at this and assumed that your 3-year rate of return was going to be the new assumed rate of return for the next couple of biennia, because ultimately, well, yeah, let's say that you change your assumed rate of return to what your 3-year is there, and we had to go a couple of budget cycles utilizing that. Same thing, middle of next month. Could you get me some kind of a look out over the next 5 fiscal years as to how much additional contribution the systems would require?
Sure. I think the best thing we can do, we'll do that. I doubt whether it'll be 4.6%. I'm not sure what it's going to be, but we're in the process, and through the year end, we gather, and GRS gathers capital market projections from about a dozen highly qualified firms, most investment managers, some consultants. And when we get that, we can get back to you also and say, here's what the outlook looks going forward. It'll be more of a 7 to 10 year look, not a 3-year look. But I at 5.25 for the 2 plans and 6.25 for the other 8 plans, I'm pretty comfortable. We are at the most conservative range of anybody in the country, and some of the stuff Brad will show will say the same thing. So I doubt whether there's a need to lower the 5.25 and 6.25, and there might be some justification, particularly on the state police, to raise the 5.25, and maybe on some of the C plans too.
And Dave, trust me, I appreciate the caution in that. I would, for the purposes of an exercise of if the whole thing ends up, the whole thing being the worldwide economy in a longer term downturn, recession, call it what you would like. Hopefully we don't get further than recession.
Yeah.
Just so that we can start planning, right?
Yeah. We've had in the past, what they call the lost decade, where equities earn nothing for 10 years, effectively nothing. So that's on the radar, and trying to protect from that. At the same time, fixed income yields are going up to help offset that. But yeah, I understand.
And we can certainly put together, what that would mean, what the portfolios would look like under that 3-year number if we assume that was what the portfolio has earned over a 3 to 5 year time period, as well as the difference between that and what current capital market assumptions, given our allocations, would mean.
Yeah, very good. Thank you, man. Thank you, Mr. Chairman.
Thank you. And that's all the questions I have as of right now, if you want to proceed. Okay, excuse me. Representative Tipton has a question.
Thank you, Mr. Chairman. Dave, and hope you guys get to feeling better soon. I don't know if this was part of your packet. We have in our packet information about the assumed rates of returns and investment returns from various state systems. And of course, Kentucky is by far the lowest on that list at 5.25. The next closest is Michigan at 6%. Have you all done some long range predicting on at what level of funding would you need to be at to increase that assumed rate of return? Where do you need to be? Or have you all talked about that, or is it still even too early to have those discussions?
No, I think we'll be having those discussions in the spring. Each of the C and the K boards will, in conjunction with investment staff, but importantly with GRS, they'll be looking at a 7 to 10 year horizon, and almost certainly they'll have input on what expectations are. But there's a part of your question I missed that I want to address tonight.
I was just referring to what are your projections on when would you at what level of funding would you need to be at to even consider changing these assumed rates of return? I know that's a tricky question.
It is, and the KNON has is currently 16.9.
Mm-hmm.
By the way, when we began to get our additional funding, it was 12.9, and it's probably going to be between 18 and 19 at June 30th for June 30th, 2022. It's not a precise quantitative measure. There's a bit of judgment involved, but I'd like to reserve that until we have those discussions with the actuary and their projections in the future.
And I do have one additional question, and it's not in your presentation, but it's some information in the next presentation that impacts KPPA, and that is the basis points for management fees and incentive fees. Could you elaborate on the total basis points that are going up, and particularly the incentive fees are going up? Could you elaborate on the reason for that?
Yeah, management fees will be coming down. I think you'll see they've come down meaningfully over the last 5 years. That's what percent of assets we get charged. The incentive fees vary substantially from year to year, and they're driven by the excess profits that those managers earn. So when we have a good year like last year and up 25%, incentive fees are likely to be really high. And when we have a bad year, they're likely to be low. But they're tied more to the private assets, not to public assets. So in fact, private assets did much better than public assets last year, so it won't be quite as much of a swing. But it's all driven by market levels. Nothing we established other than in the original contract.
Yeah, those are all performance based on the incentive side.
Yeah, we do calculate them differently than teachers does, and I'm trying to come to a resolve as to we ought to do it the same way. Their methodology is different than ours. Neither one is wrong or right. It's just we do it differently, and I'm inclined to think we ought to do it the same. And we've had at least one conversation with them about doing that. And I don't want to forecast, but I might say I'm leaning more toward the way they do it than the way we do it. But we'll try to reach some resolve.
Thank you.
I had one more slide, if you could, just to quickly. Because I know
Before you do that, Representative Miller has a question.
Actually, Mr. Chairman, it's more of a comment, and it's the first time in my 6 years on PPOB that KERS 30-year return has been higher than TRS's 30-year return. And that's the first time in 6 years I've seen that, and which says everybody reverts to mean eventually. That you look back over 20 years, that was the .com, the recovery off the .com. Now that the recovery off the .com crash is out of it, these two plans are managed very closely, historically in terms of percentage return. So it's just a
Yeah.
kind of a
It's,
comment. I don't know if Dave, if you want to have respond to that, but
well, you're picking a very favorable point in time for us because we're so conservatively managed and we're at the market decline. But at the same time, I think we've done a really good job of adding value to what we could have gotten ahead. We've been totally passive. So, $20 to $40 million a year effectively over a 30-year period of time. The equivalent of that is quite a bit of impact. But I know Senator Higdon is very interested in how we save money. And I had one more slide that would kind of deal with that, if you would.
I'm excited to see that. Please proceed.
Yeah, I call it looking forward. We have been slowly developing a look at our staffing going forward. And I say slowly because we've had the departure of a CIO. We have a massive reporting and data project going on. We're short-staffed. Steve and his people are, I'm getting 10 p.m. emails. But we pulled the CIOs together. We're developing a 3 to 5 year staffing plan. We're going to adjust some positions to reduce the siloing. So not just somebody who does real estate, somebody who does private equity. We want more interaction, more collaboration. So the description will be written differently. We are beginning to recruit for the 3 18A exempt positions that we have, starting off with real estate. We're going to be adding a senior level fixed income person to support Steve. We're going to be hiring additional junior and support staff. We want to lever the senior talent we have without adding more. We're focusing on areas to reduce investment related fees and expenses. And that's Senator Higdon's encouragement to us. We can do that by moving more assets from active to passive. If we can find areas where that makes sense, we can do it by moving money in-house, if that makes sense. And we're looking at that right now. For example, core fixed income might be one area. Structured equity might be an area where we do more indexing. And then finally, we're just analyzing the things we do and the resources we got. So I would say we're getting much more active in how can we run this operation better.
Dave, that certainly makes me smile, and I appreciate that. And a lot of people, we've talked about this over the years, where these fees come. And there's no magic pot out there.
Yeah.
Senator McDaniel. It comes out of the corpus of the retirement funds, and so every time you save $1 in fees, that's $1 extra we have in the fund. So I appreciate you watching that, and thank you for that report.
You're welcome.
You have another? Is that it? Does that conclude your report?
Yes.
Yes, sir.
Okay. Any further questions from the committee? I know, okay, Senator Thayer has a comment.
Thank you, Mr. Chairman. For those of you who were in the local government committee meeting this morning, this will be repetitive, but I noted that the League of Cities had some CERS changes that they intend to lobby for in the next session, and I reminded them and everyone about your request that you and Co-Chairman Tipton made to leadership that in the future, during a session, any pension-related bill, whether it's a major overhaul, a minor tweak, or a slight adjustment, needs to be vetted first by PPOB. And so I don't know if we'd put that out there yet or not. If we did, I repeated it. If not, I put it out there for the first time and wanted to have it on the record in the minutes here.
Yeah. Thank you, Leader Thayer, and we certainly have put that word out. But it's always good to hear someone else saying it also. And thank you for mentioning that in the local government committee. I know a lot of people are shocked that we'd be out here in 1 hour, but I entertain a motion to adjourn.
Oh, hang on.
Hold on a second.
We have Brad's presentation.
Okay, Brad. All right. I didn't see that on the agenda. You're LRC staff then, right? I thought you were in a hurry to leave, Brad.
Sir, this is the most partisan thing I will say. I'm happy if you want to adjourn and have me not speak.
Well, since it's my mistake overlooking your if you had it down that you were presenting, I would have called it, but it just said LRC staff. So, Mr. Staff, please proceed.
All righty, so I'll go ahead and get started here. Let me get the presentation up. Slideshow. From beginning. There we go. All right, so I am Brad Gross, the Committee Staff Administrator of the Public Pension Oversight Board. I will say up front, as I said last time, taking over this task from Bo Craycraft, who was a good investment guy. I am not an investment expert. I don't play one on TV, but I will certainly do my best to answer your questions and to kind of walk through our annual investment review that we have to do as part of our statutory duties. The systems looked over the September 30, 2022 returns. This is looking over the fiscal year ended returns that we've had them come in and report on. And this is just to try to provide a little bit additional information, kind of aggregate what they do, look at some peer analysis, and to provide some information to you all. So certainly we'll look over total assets, performance, allocation, fees, net cash flow, the information we've typically provided annually, one special topic which is relatively short, and a few other required things, and I will certainly try to be as brief as possible. So certainly when we look at the total asset pool for the fiscal year and year ended 2022, as the returns were down, certainly the asset levels were down. Assets for the pension funds across the board dropped $4.34 billion to $38.07 billion. The insurance funds dropped $0.65 billion down to $8.83 billion. That compares last year where we had an increase of $8.4 billion to the pension side and $2.2 billion to the retiree health side. And just as a note, in these asset values on the pension side, that does include the $250 million of additional appropriations above the actuarially determined contribution that you made to the state police fund and the $479 million that you did to pay off the green box dollars. So just as a kind of, this question kind of got brought up and I included this slide. So last year we certainly had record returns and we talked a lot about those things. I think every pension fund in the country issued press releases and it was a great time to hear really good returns. Average returns were around 27%. And so ultimately, how do those things impact our funds actuarially and the contributions that you all pay as elected leaders or that you include in the budget? So when there is a positive return, so like last year, if the return was average 27%, most pension funds have around a 7% assumed rate of return. So that means when the valuation comes up, when they go do the actuarial work, they're going to have plus 20, if you will, of an experience that's going to get filtered into the valuation. Now, all public pension funds typically they smooth out their gains and losses over a 5-year period. So we're still smoothing into that gain, if you will, over the last year, over this year and the next 5 years as we go along. So those things positively impact our funds. You may remember last year we talked about that the funds projected funding levels and unfunded liabilities in many cases would go down, or that their rates would go down, or that their rates wouldn't go up as much. In fact, TRS had assumption changes last year that they are smoothing in at the same time as they did the investment gains from last time. Now, the opposite side of that is certainly this year, where if we look across pension funds that are greater than $1 billion, the average return has been about negative 7%. And this is just kind of a note. Sometimes we look at these two returns and go, oh, there's a lot of excess gain between these two different ones. If you look on top, you're talking about a plus 20 against that assumption. If you look below, you're looking at a negative 14 because everything zero value is based upon that assumption, not based upon zero. So certainly those things will produce actuarial losses and certainly increased costs from what the projections were last time around. Now, that being said, we probably haven't wiped out all of the gains from last year, and it will vary by system, but you will see some sort of impact when we start looking at those projections going forward. So, FY22, what performed well, what didn't? Well, certainly you can see there on the top left, these are indexes or benchmarks that pension funds have, private real estate, commodities, and private equity did well. And in fact, even when you look at that private equity at 14.9%, there is no real good index to point to because it is a non-publicly traded asset. Most pension funds probably had 20, 25, 30% returns on private equity. But you can certainly see in the fixed income, the equity markets, when you look at the large cap, you're looking at negative 10.6 for the year. That's the S&P 500. So we should expect pension funds that have a lot of private real estate, commodities, and private equity, if they have more of their portfolio dedicated to that, we should see higher returns. If we look at a pension fund and they don't have as much of that and they have more traditional equities and fixed income, we would expect their returns to be lower. And in a minute, when we look at kind of the average of states, we do a peer group each year. If you look at the average of states, it is kind of all over the place. But the ones that performed the best for the fiscal year ended 2022 had more of those kind of top three asset classes. So certainly, as mentioned before, and I won't go over it, it's been FY22 had some interesting things about it with inflation, interest rate hikes, consumer sentiment. And just to give you an idea of what that one quarter did, the S&P was down 16.1% for the quarter. The S&P for the whole year was down 10.6, so it was a rather precipitous drop just for that one quarter. There's a kind of an important thing to talk about when we talk about these private real estate, private equity, these non-publicly traded assets. Their returns typically lag about a quarter. So when we see these really high returns that are well above your traditional equity markets, you have to sit back and go, okay, why is that? And certainly part of this is going to be that there is a lag. And probably over the next couple of months, the literature I've been reading, I've talked to the systems a little bit, we're going to begin to see a write down in the value of those private assets. So they're not publicly traded, which means they value them at some point. Think about your mortgage on your house. Your house is worth what the market says it is, but you might have an appraisal that has a number from a year ago or 6 months ago that is different from what the market value is today. And so private equity firms and so on will value those assets as we move along. But if the market continues to stay down, we'll still see some write-downs in those asset values as we move along.
Brad, I have a question from Representative Duplessis.
Thank you, Mr. Chairman. Would you like to weigh in on the change in chairman affecting? I still believe it has major impacts, Mr. Chairman. No, could you speak to the changes that we've seen in interest rates? We know that low interest rates were one of the reasons why we've had lower returns for many years. Even when the markets were up, we were told that was holding us back, that the interest rates were hurting us. So now that we have elevated interest rates, which is hurting housing, but it's helping us, I guess, in pension, right? Can you explain how that impacts us?
Well, certainly, and it's funny you mentioned this now. Keep in mind, I mentioned I'm not an investment expert, and I did read up on that. Afraid I might get that question. Certainly, from what I can understand, and the folks before me might be able to speak to that much more eloquently. But in the short run, certainly, like when we look at the Fed fund rate and things of that nature, so housing prices or the interest rate on homes will go up. The interest rate that businesses deal with, they're going to go up. And so that has a drag on things like equities, if you will. And it certainly can change, the bond market. So at least in the short run, this is breeding commentary, if you will, is that it has a potential negative impact as we kind of ease into this, certainly. And certainly that impacts what people buy. I don't know about you, but as interest rates go up, I tend to have less debt. I tend to spend, certainly inflation's up at the same time too. So I'm spending more on basic goods than I am on things that are fun in nature. But I think it just creates problems for the markets right now.
Okay, thank you.
But if I knew what it was going to do in the long run, I wouldn't be here.
Nor would we.
So these are the returns as we kind of look across all of our funds, just to aggregate those together. Certainly a negative year between negative 4.6 to negative 10.9 for TRS. And there's kind of three ways that people typically evaluate pension funds on their returns. And certainly 1 year is something you look at because it has an impact on your next valuation and how much you pay, but certainly also looking at those longer rates of return. And so we've got the 1 through 3, 5, 10, 20, and 30-year returns. So your policy benchmark tells you, how did you do against a basic index fund like Mr. Eager talked about. You can see our assumed rate of return. Are we looking at something that's going to produce actuarial gains or losses? And then down below there, you'll also see some peer groups. We go out and look at the quarterly fiscal year-ended returns of all the pension funds that we can get a hold of. Believe it or not, you can go to some states and right now and you can't find out what their year-end return is. You won't find it on the internet. You won't see it until you hit their annual reports toward the end of the year. And you can kind of see down there our peer group average was minus 4.9% for the year. And trending on over, that was 8.4% for the 10-year. I've included two other benchmarks that we were able to find that were out there of larger funds and smaller funds, and you can kind of see those as well too. So that's kind of three ways you can look at it. How did our active management do? How did we do actuarially? And how did we do against everybody else? But certainly a down year across all funds. But I will say this, there is a lot of volatility when you look at the rates of return. So this is a scatter plot of the pension funds that we looked at, which is all of the state employee plans or statewide plans and all the teacher plans that are independently operated that we could get a return for. And there is a one-page sheet in there if you want to look at all the individual states. They're 1, 3, 5, and 10 if we could find it, and their assumption. And certainly one of the questions when I put this chart together was, okay, who's at the top? And what are they doing, right? So if you will remember back when we talked about there were 3 asset classes that did really, really well. Well, these top performing funds have a huge allocation to private equity, private real estate, and commodities. In fact, the top one is Oregon, which is in excess of 6%, had a 30% allocation to private equity alone. Most pension funds are about 10. Our funds, are somewhere, JFRS has absolutely 0 as far as private equity is concerned. But, when you look at that, we're like 6 to 10% private equity in our funds, just as a measure of that. And if you want to know details of those funds, we can certainly pull that out. But a lot of variability when you get in there and you can see KERS non-HAS and TRS. It's a good fun chart we have every year, but this is the 25-year return each year that you can look at as far as seeing kind of the ups and the downs. There were years where KERS, CERS was the highest returning fund. There were years where TRS was. There's years where LRP and JRP are. And certainly this year where, KPPA is the highest returning fund based upon their asset allocation. We talk about a lot of the same things over and over again. Asset allocation typically drives 90% of the return. So what asset class are you involved in, whether it's equities, fixed income, alternative assets? And you can kind of see a description of those. We keep those in there every year. But on the right, you can see that the average public pension fund from the National Association of State Retirement Administrators is roughly half the money's in public equities. A little over 20% is in fixed income, 2.5% in cash and what they call other, but mainly cash, and around 30%, 29 to 30% in alternatives.
Brad, Senator Wilson has a question for you.
Brad, thank you. I'm over here.
Oh, hey, sir.
When you were talking about 6 to 10% of private equity, does that include private real estate as well?
No, sir, it does not.
Do you happen to know the number or the percentage of private real estate?
We can, as far as like what our individual funds are, I think most of it's private, but we could get a number from them. I've got a real estate number in general on a slide going forward, but we do have private real estate as well here.
Because I know where my son farms in Mississippi, they have 16 sections, school sections set apart by the state, that the funds for renting that mile square land, I think that's 640 acres. You know, and they pay so much per acre anyway. That goes to the schools. But also, I found out that there are teacher retirement folks that actually purchase land as an asset there and then lease it back to a farmer or somebody that wants to farm it. And that turns out to be a very, very stable investment. So anyway, I was just curious. Thank you.
We can certainly, we'll get a memo together and provide some detail on that.
Thank you.
So this fun little chart just kind of shows the asset allocation by asset class for each of our funds. Certainly, CERS has a little closer to a typical portfolio, except they got a little bit higher allocation to fixed income, lower allocation to the alternative. KERS, certainly a very low equity exposure, which is kind of typical for the fund being 16.8% funded. TRS certainly moves up that, and LRP and JRP as you see the equity exposures. But you can see the public equity in blue. The green shaded is public and private fixed. Private equity would be that brown number, so you can kind of see that range there. Real return, which is typically real assets, things like timber, if you will, land and so on, would be that purple. Real estate would be the yellow, and then the cash would be the gray. And certainly Mr. Eager talked about the cash allocations, and they're working to deploy those. Just to something a little bit easier to see, if you want to see what these average returns are, against those comparisons in each of our funds in kind of a basic level, you can see that. I've also included a peer group from Cliffwater Research, which does an asset allocation review every year. Theirs is pretty typical in the equity and fixed income, and their review that alternatives were a little bit higher in the example, and you can kind of see how we fare out. I'm going to keep going and not get too much in the weeds unless you want me to. So fees, and I'll probably go over this just real quickly. There's been a lot of discussion over the years about fees, and we've done some research. There have been bills. There have been many Senate Bill 2s in our life, and one Senate Bill 2 in 2017 was a transparency bill. And part of that bill was to basically have the systems consistently report fees, and there was a big discussion about these incentive fees at that time. So that's still an ongoing discussion among public pension funds. Is it a fee? Is it not a fee? All right, because it's actual profit sharing. It's not a physical dollar that the systems pay. It's part of the returns that they rake up off the top. But part of those bills said that the funds in some form or fashion had to report those incentive fees. So you can kind of see here, if we look at KPPA, we've listed the total fees, including the incentive fees. You can see on the blue there, looking down 2019 to 2022, which total fees have increased, including the incentive fees. Their management fees have been coming down over the course of time. But certainly incentive fees, as Dave mentioned, it's based upon, how well did the fund do? Now, if you look back and remember that private equity did really well this year, right? Then you're going to have a lot of incentive fees. And typically they have like a hurdle rate. So there's a general management fee, but then the carried interest or incentive fees are based upon hitting a certain rate of return, and then they share the return above that amount. So then you'll see years where it's relatively low as well too. You'll even see a negative in the TRS side. There's sometimes potential clawbacks, if you will, if there's a really down year as well too. So TRS, just as a note on theirs, you can see those values. They typically have lower fees in general. A lot of that, particularly on the management fee side, they do a lot of internal management of their portfolios, to one of the questions that kind of got brought up. JFRS has the lowest fee structure. You're looking at a little under 10 basis points to run that fund currently. Certainly a small fund as well too. And you can see the retiree health funds there as well. Cash flow. This is something we bring up every year, and Representative Duplessis, former chair here, this is a question you brought up over the years many times, and we've discussed it. And one of the things in years past was, how can we figure out whether cash flow is good or bad? And so we went to the actuaries at that time and said, what's a good way to look at this? And so we kind of worked through a process to calculate a percentage. And basically, you'll see that net cash flow up there, contributions minus benefits and expenses, and then looking at that in comparison to their assets at the beginning of the year. So you notice there's no investment income in there. There's no gain on assets. And so the question is, are you cash flowing? And when you calculate that as a percentage, they kind of talked about that 3 to 5% was an okay range, if you will. All right, now that would vary based upon where your plan health was, what your goals are, right? But they kind of talked about, on average, 3 to 5% was a number that would look okay. And so we've calculated those numbers here, and we've done this each year. And you'll see that chart down at the bottom. You'll see the CF as a percentage of assets. That's cash flow as a percentage of assets. All right, and so again, that's without investment return. So in KERS non-HAS, you'll see that it's a positive 3.06%, which means there's more contributions coming in than there are benefits and expenses going out the door. And I do have to note House Bill 8, because we're getting contributions, steady level of contributions, and certainly the quasis are paying their full part of that. That's a positive number, and certainly that's been positive, but you can see down below there what the 2021 value was. At 0.8%, that value has improved. Assets growth helps too, but that number is positive. And in a fund that's 16.8% funded, cash flow is kind of the devil at the door, if you will, right? That's what's going to build your asset pull up. And you can kind of see the funds as we go along there. SPRS has this really great number, and that includes that $215 million of additional appropriations that they got. If we were to adjust that and take out that $250 million, it still would have been positive at 0.67. TRS, you do see some improvement this year, but that also included those green box dollars that were paid off. So it's at 1.17%, below that 3 to 5. If the green box dollars were not included, that would be at 3.02%. And certainly as we kind of move across, I do need to note legislative retirement plan is not receiving any employer contributions. So it's, as we've had those discussions before. Just a quick special topic on assumed rates of return. We kind of bring this up every year, but this is a trend that keeps changing, and it seems to be changing by the moment. It's a little confusing, but if you were to look far left on this chart, in 2001, where that 0.1 is, you could see where public pension funds were as far as assumed investment returns. And you can see that most everybody had an 8% or above assumed rate of return. The average was 8%. As we scroll across, and in particularly over the last 10 years, there's been a pretty dramatic shift. And we're now at a median average of 6.94%. And if you'll look at that far right, and for fiscal year 23, there's no one above 8% anymore, whereas it used to be the commonplace assumption, if you will. And in looking at funds over the last, we've looked at each of the state funds. Several of them are still phasing in. I think you're going to continue to see this trend, these funds to come down. Part of that's what their expectations are as far as returns are, but it also impacts cash flow and things like funding levels, because if you need more contributions, that assumed rate of return is also your discount rate on liabilities. And so when you drop that, unfunded liabilities go up, unfunded liabilities go up, contributions go up. So it's not just an asset side of the equation number, because the two are generally tied together in public pension funds. I'm not going to do the due time. We can certainly talk about it, but these are some basic things that we have to go over. We try to look at their investment policies. Have they had any securities litigation recoveries? Their benchmarks. Your benchmarks are here for them to look. They're generally all using standardized type benchmarks to compare their returns. Certainly, and Dave kind of talked to this about asset allocations and targets. The boards establish what's their targeted asset allocation, how much do they want in public equities or fixed income, and then what's their allowable range. I mean, one of the things we've talked about here is where KPPA has had some issues with cash coming into the fund and being outside of allowable ranges. The values as of 6/30 are listed here. TRS had a slight overweight to alternative or above the range. But I will say KPPA has had a shift. They are moving these numbers more towards the allowable ranges as of 9/30. Any questions?
Have any questions? Representative DePlessis has a question.
I really don't have a question, Mr. Chairman. Thank you for letting me speak, but I did want to address just the whole cash flow thing that Brad brought up, and thank you, Brad, for this, as always, detailed report. Mr. Chairman and Mr. Co-Chairman, I don't have much more time on this board, but I really would like to emphasize one of the things that we've struggled, and we saw it today, is having the different systems report to us in a conclusive and way that's all three are doing the same reporting format and in data that we can digest. And I think that the way that Brad presented this cash flow as a percent would be a good way for us to start it's one of the things they should be reporting all three systems to us so that we can see that cash flow, because it's important. We need to see it with and without what the monies are that the state is providing, because it obviously makes a pretty big difference. So again, I'm just making a comment to the board. I think that was an important thing that we shouldn't lose sight of and should add that to our reporting requirements. Thank you, Mr. Chairman.
Thank you, and we thank you, Representative DePlessis, for your leadership and over the years. Thank you very much. Brad, I don't see any further questions. I want to thank you and your staff for the great work that you do, and very dedicated to this committee. We appreciate it.